Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, May the 10th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. What we're trying to do here is to teach you some different strategies you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you're already doing. Having that out of the way, let's get this on. Not a whole lot of economic data today. We did have Mario Draghi speaking earlier on this morning, and some industrial production out of Italy, but came in line pretty much with expectations. And French industrial production actually came in slightly higher than expected at 2%, was expected to be 1.2%, so a little bit higher than expected there. Then here in the United States, we had crude oil inventories, and as you can see from the chart here, crude oil inventories, big drawdown, more than expected. A drawdown of 5.2 million barrels was expected to be only a drawdown of 0.2 million barrels. Now, if you remember last month, we had a lot less of a drawdown than what was expected. This one really trumps that one, and as you can tell, crude oil futures moving quite a bit higher, up $1.56 on that data point. So, crude oil moving higher, and anytime there is bullishness in crude oil, it has a tendency to really get people coming out of the woodwork and driving this higher. So I'll talk about a trade that I'm putting on for that, or I put on for that one a little bit later on in the commentary. But gold futures also moving higher. Equities, for the most part, we'll talk here in a minute, but gold futures have had a rough couple of weeks, and today starting to rebound a little bit. It does look like we are slightly lower than when we opened, but at the end of the day, gold futures up almost $5 today after a nice rebound yesterday. It was down quite a bit, almost $20 yesterday. Came back a little bit. Bonds, up 9 ticks on the day, but for the most part, just a pretty quiet day. These two dojis, yesterday it was looking like that it was kind of build a little bit of a bottom, maybe come back up to this point of control. We have done that, but today, as we've slid off a little bit, looks like it could be more of a continuation pattern. But as I've said time and time again, I really don't see it going outside of 145 to 155 for the most part. It's a pretty wide range, but the market could jockey back and around, but doesn't look to me like the Fed is going to raise rates until later on in the year, maybe right after the summertime. So bonds have already priced that in so far, just of about another 25 basis point or 25 basis point move higher. Dow Jones Industrial Average down slightly on the day, down 23 ticks, but as you can see, we're still stuck in that range, and the point of control for the volume moving up right to where we are. So value being accepted at these levels right now. Then the Nasdaq value quite a bit lower, not a whole lot of volume up here, despite the fact that we're seeing historical highs in the Nasdaq giving up about 3 points on the day, almost 4. But yesterday, just as a note, because I say it seemingly every single day, new all-time historical high in the Nasdaq printed yesterday. Then with the E-mini S&Ps, they're actually pushing a little bit higher today, up a point on the day. A lot of the drag on the Nasdaq, the Dow, things of that nature, was basically Disney came out, really got pummeled. That brought down the Dow. Nasdaq had Yelp, Priceline, and a couple other ones bringing it down. On the flip side of that, we did have EA Sports just knock it out of the park today, and up over, at one point, last I saw, was up 14%. So EA Sports beat the street on their earnings by almost double. I think they were supposed to come out with 70-cent earnings or something, and really just knocked it out of the park. I think it came out well over $1. Anyway, E-mini S&Ps breakdown. Here we are stuck in this trend sideways, completely trending sideways. And like I've talked about, this volatility, actually the VIX broke down below 10 today, looking like it's going to go to about 7 or so. And with this kind of trend sideways, it's not surprising whatsoever. Just not a whole lot of volatility, not a lot of volatility expected, and the overall market's reacting as such. So, or the VIX volatility acting as such. On a few trades that I've done, USO, remember I've been talking about this 9.5 area as acting as support. It has held several times, and today confirmation covered this gap. I think it's going to start to, at least for the next several days, like I said, the bulls in oil are going to hold on to that massive drawdown, more than expected, by over 3 million barrel drawdown than expected. I think that's going to bring those guys out. Crude oil could want to go up and test that $50 a barrel psychological level. And so I decided to go in there with the USO and add a little bit to that trade, and went into the June, sold the the 9.5 puts for 25 cents. So I'm going to look to try and cover that. If we can come up and test this value area, I should be able to get out relatively soon. It's got a high implied volatility right now from the sell-off there, so it's above 30, which is meeting my guidelines for an ETF on USO, and it's right there in the sweet spot of that, just 37 days to expiration. So we should start seeing a lot of implied volatility come out of that as we rally, and we should start seeing a lot of theta decay happening in there. So hopefully I can get out of that one rather soon. IBM. Now you guys know my conundrum with IBM. Had this on the earnings. Heard Buffett started dumping his shares up at around 82. I actually took on a long position at 165, and that pulled the ripcord on it, and decided to roll down my calls just a little bit and add some more puts to this, because I just think it's overdone. At the end of the day, IBM has not made money, or not done very well on their high cost, low margin sector of the company, which is like the service sector. I just don't think that they're really spending a whole lot of time trying to deal with that when they can have this Watson, which is the AI software, and the cloud computing, which is high margin, low cost. So that's really how they beat earnings. If we look at their earnings, they beat the street on earnings, but the street didn't like the fact that it had to do with their service sector coming off a little bit. I think they might be starting to pivoting away from that and going for the high profit area of the company. So I think that this is just a little bit overdone. We are kind of stuck here. It does have a low implied volatility, but I'm trying to manage this loss, so I'm kind of bending my rules on high implied volatility with this one. Decided that I could get a little aggressive with it. So in that, I was able to basically roll my puts my calls down in IBM, collect another 25 cents for that, and then sold some more 145 puts for 70 cents. So basically I have on a big strangle in there in the June right now. So all in all, collected just under $1 for that roll and add to that trade on IBM. I think it's just going to have to go up, and again, I'm willing to take IBM at 145. I liked it at 165. I love it at 145. So put it to me. Somebody bring it on. Anyway, on to the next one. I've tweeted this out yesterday with Priceline, ticker symbol PCLN. I also had somebody come out and say, they don't have very good markets in that option montage. Well, you guys watch my daily market commentaries. It actually fits the rules of how wide the bid ask should be in the montage, especially for a $2,000 stock. But anyway, I went in there and sold the strangle. Got a little bit nervous this morning. It actually exceeded the market maker move. The market maker move was somewhere around 75. I basically went out 150 on both sides, was able to collect a nice little premium for that. And with Priceline, I sold the May weeklies and sold the 1,760 puts, and then the 2,050 puts, or sorry, calls. So the 1,760 puts and the 2,050 calls to create that strangle, and I was able to collect about $4.40 for that. Covered it this morning for $2.20. That's a lot better right now, as when I covered that, it was down about 105. It's really made a move back, but I like to try and cover these going in right around that first 15 to 30 minutes of the day. And this market was really kind of coming off. It looked pretty good this morning. It was only down about 65, 70 in the pre-market, but as soon as the market opened, it just really started dropping. So I just didn't want to hold on to that one too much longer, as the value area being right here, the gamma would have really started affecting those puts that I had on. So I pulled the ripcord on it a little bit early. You can probably get out of it a little bit better than I did. Last I checked, it was trading around $1.50, so could have saved yourself another 70 cents, but you never know, which is why I ended up getting out of that rather early. All right, so that's all I've got for you guys today for what I have done. But Friday's webinar, we're going to be doing it on synthetic longs and the next week synthetic shorts. And the reason why I love this strategy so much is because if you're a trader, not necessarily talking to long-term investor, but if you're a trader and you're in and out of different stocks and things of that nature within a couple of months, this is the strategy to implement if you want to participate in the upside for an underlying and have the same risk parameter. So you have to know how to implement this if you're a trader, and I'm going to show you all the rules involved in how to set this up in Friday's webinar. So you got to check that out if you are considering yourself a real trader and want to know how to synthetically create a long position in an underlying and use about 75% the margin. So 75% less in margin that it would cost to go out and buy something. So helps you build a better portfolio for the most part with the same amount of money, 3 times the size of what your account would handle if you were just going out and buying those stocks, right? So check it out. Go to protraderstrategies.com. That's all I got for you. If you can't take that, take it easy.